but what are some of the things that you can do to create a bit of a pattern so that you can quickly identify deals that at a surface level work, and then ones that most likely don't?
One rule or one system I like to use, and I just mentioned this before I came in, was what I call the 0.6 rule.
And I have a similar one, so that's why I called you out on it, because I'll tell you what mine is. I'm here with Jacob Campanero as usual, and today we're talking about deal shortcuts. I get a lot of people I talk with, coaching students, some of them, who end up evaluating deals that just at a surface level don't make sense or likely won't work. And I don't have my computer on me right now. We're just going to talk this one out. But what are some of the things that you can do to create a bit of a pattern so that you can quickly identify deals that at a surface level work, and then ones that most likely don't? There is a caveat to that. Jake, take it away.
No, I was just going to say it's a great topic, something that I think all investors struggle with or need to build a system for. I personally find that, you can get analysis fatigue, right? You go on MLS and there's, 87 apartment buildings right now for sale over 6 units. Are you going to sit there and go build performas on 86 apartment buildings? If you have the time, sure, go for it. But, there's really, I believe this is a great topic because we're going to get to the bottom of how do you build these systems, right? How do you quickly look at a building and say, okay, is this worth going deeper on, right? Can I spend my time, because that's our most valuable commodity, right? And dive into this deeper. And it helps everybody, right? It helps any investor, whether you're new, been in it for a long time. Let's build systems. So one rule or one system I like to use, and I just mentioned this before I came in, was what I call the 0.6 rule.
And I have a similar one, so that's why I called you out on it. Because I'll tell you what mine is, but you explain this one first. If you want.
No, it's very simple. So most people have heard the 1% rule.
Yeah.
Right.
Okay. I used it very similarly.
Okay. So it's probably the same thing, right? But you use the 1% rule, and everybody, and newer investors, they call me up and they say, Jake, okay, I was listening to Bigger Pockets. I was listening to this. I was listening to that. And they go, can you help me find something that works with the 1% rule? Right. And I said, it's tough because I'm like, well, we're in Ontario.
Like the average deal probably transacts at what, like the 0.5% or 0.4?
Yeah, right.
Yeah.
So that's something that, number one, setting expectations, 0.1 rule. I'm not saying it's impossible, but I'm saying it's very, very difficult to find. I don't think I've ever done one at a 0.1.
At a 1%.
That's a 1%. Sorry, 1.1.
Yeah.
Yeah.
Okay, so let me give you the genesis of where this started for me. So back when I did a lot of student rentals, I had a company that we would buy them, renovate them, and sell them. I would keep some. And I was constantly evaluating properties. And I'd even be open to just buying one and not renovating it right away if it met a certain criteria. And I determined that if I could get 0.65%.
So you're very similar. Okay.
If I could get 0.65, and I had factored in I had factored in the cost of the first mortgage, like with the current mortgage rates, a 30-year AM. I knew all the things I could get. I knew what I typically paid for maintenance and property taxes. So I had ballpark numbers in my fields in my spreadsheet. And the reason I came to 0.65 is I recognized the pattern. I'm like, surely there must be a shortcut here. And I'm not talking about what I would use as a way of disqualifying all deals or saying that's a good deal, but it would be, do I want to look, how close are we to that rule? And do I want to look further or not?
And the fun thing is you can work it backwards as well. Right?
Yeah, you can.
So rather than trying to calculate what the percentage is, you can take the percentage and calculate what the purchase price should be.
Yes, exactly. Right? So you can apply it in the reverse. So you say, hey, here's where my offer is probably going to be. Does it make sense for me to have a conversation with this seller?
$100K, $50K, or
how far off are we?
Off, right? And that's the difference.
So this came after using my spreadsheet, which you guys can get on my website, andrew-hines.com. You can just download that spreadsheet for free. But I would...
Speaking of that, it was funny. I just want to tell a story.
Yeah.
So the other day, I think I sent it to you.
You saw it. This looks familiar.
Yeah, there was like a wholesaler or something from Sudbury.
Yeah.
Like completely different market. He sent me a deal, and it was on the Andrew Hines special. Yeah. So I thought that was funny.
Yeah, and I see that. I'll be scrolling through Instagram. I'll see it in people's stories or taking pictures of my spreadsheet. Not as much as they used to, because real estate investing isn't as sexy as it once was. But okay, so I'll give you the example. This is where I was at. So I would have 5 bedrooms at $695. I knew I could get that in a certain area. Yep. I knew I could get 5 bedrooms, $695 if I had the house in a certain footprint. So like assuming that I knew I could get that rent, doesn't matter what the current rents are. I just knew that's what I could get. So then I would work backwards. I've got 3475. So if I just divide that, that's 695 times 5. It's more now, way more. And then I would just divide that by 0.0 and what is it? 0.065. Is that right? No, I needed one more.
One more 0.
Yeah. So 695 times 5 divided by 0.0065. Yep, 534,000. That's what that building was worth. I was very confident that I would get an appraisal at the end.
Yeah.
More.
It
But
came in more.
this was just for a brief period in time when I was analyzing deals. That was the rule. It was the 0.65 rule. Eventually,
Now that does change with interest rates. It changes.
it changes with
times.
everything. This just worked for a time.
Yep.
And that rule will change. But this is one example of a shortcut. If you're looking at a lot of deals,
Yep.
you just start to adapt. And then the other one I came up with, which is way more basic, but I just had my spreadsheet with some numbers pre-programmed in, assumptions for a certain type of house I was looking at. I knew that if I could get a 6 cap or higher as is, I could come in with private money as my down payment.
Yeah.
And a first mortgage with the bank, and I'd still cash flow. I knew that was true, and I could just use that rule across the board.
And so the other rule I was going to suggest, funny enough, is actually very similar.
Yeah.
But it's skipping the lengthy process to get to a cap rate. So essentially, as you mentioned, right? When people send me something or they say, "Hey, Jake, what do I do?" The guy doesn't have the taxes, or he's not sending me the utilities. You're not sending.
You make an assumption about operating.
So you make an assumption about operating costs, right? So you look at enough buildings. I've been in this long enough to look at enough buildings and say, okay, in general, a value add building currently operates, and it usually has an expense ratio of about 30 to 35%.
Yeah, so you could do a low, medium, and high, or you could just go on the high, like assume it's 35%.
Usually when it sits as is, that's 35%. Now, obviously there's outliers, these are generalities, but and then as you get to a turnkey asset, it tends to be closer to 25 to 30%.
Right, and that's because the rents are much higher compared to the floor area. Yeah, more efficient buildings, less things breaking.
Tenants pay for water now, not just hydro. So there's different things, but yes, I always go.
So let's give an example of how that would work.
Sure. So we take it in, we look at it. It's 99.9% of the time, if someone's marketing a building, they're going to give you the gross income.
So if it's a sixplex and the average rent is $1,500, that's $9,000 a month. Yep. So if we multiply that by 12 months, that's $108,000 a year. Okay. So if we assume
let's subtract 30%
as expenses.
Yeah.
So I'm just going to multiply it by 0.7 for what's left. So that means there's 75,600.
Yeah.
If it's 30% operating expense, that means there'll be 75,600. And this is just calculator math, very quickly done on the spot. So then what do we want to say that's worth? Do we have a valuation if it's 75,000 operating income?
Let's apply that to let's say 5% cap rate.
Yeah. So divided by 0.05. So that's worth 1.512 million based on a 5 cap. So that's just very quick, back of the envelope numbers, not to make a decision on. The only decision you're going to make on that information is if you want to look further. That's it. But what this does is if you see that number and you know that the seller's asking for 3 million, you might choose to spend your time on the seller that's only asking for 1.75.
Or like even 2 million, right? Because usually the sixplexes, they're like, 2 million or this or that. And you can look at it and say, okay, great. So that's rule 2.
Yeah.
So we've done the point whatever.
The
rule,
0.6,
right?
0.65.
0.65, 0.6. Now again,
that's not an actual rule. It used to be the 1% rule, and this rule is entirely dependent on many factors.
And I want anybody who listens to this to go and look back at their math
and create your own rule.
This rule.
Yeah, run this rule.
Run it on everything you've purchased. Run it on everything you didn't purchase. And build your own rule. It might be 0.8. It might be 0.1.
It might be 1.
Right?
I mean, you might have to go to other markets to get 1, but you can get that.
Yes. So run that. Yeah. The other option is assuming the expense ratio, right? So just saying, okay, in generality, again, go back.
Where are my expenses
go back
usually?
To your math and look at what most of the buildings operate. I can tell you right now, it's going to be sitting somewhere between 25 and 35. That's standard, right? And then run your cap. The third, what I like to teach anybody who comes work with me is just look for dollar per door. Right?
Yeah, I was going to say that's simple. The easy one. Yeah, right? Yeah. So what have you come to expect if it's a multifamily in, say, Hamilton?
Yeah, anybody that comes and works with us, we have a heat map, I guess I'll call it, right? And it's essentially, it shows circles coming out from downtown Toronto, right? And we've built this ourselves. I'm sure you can find it somewhere, but and essentially we give dollar per door values as you go out. Now, obviously, from Burlington, it's going to be different. From Hamilton, it's going to be different. So you look at these different markets, but we say, in generality, you can assume anything in Burlington is going to be going between, $250 a door. Grab it right now, right? $300 a door to $400 a door. I would consider looking at it. $500 to $600 a door. Don't even bother.
Yeah.
And every market we have this.
That's a great multifamily hack. A little less clean when you mix in some mixed use.
Yeah, mixed use. Yeah, you got to apply for mixed use, and then it even works for. It's very similar to just looking at like commercial, true commercial, industrial. You can say, listen, it's 300 square foot
to buy.
Burlington. Yeah, we can look at the sales, and we can say confidently. And this is what appraisers do. This is
I was going to say a great way to get a basis for valuation is go read a couple long narrative appraisals. Yeah, you'll really start to see.
Or just look at sales data.
Sales data is too. Yeah, I mean, I don't mean read the whole thing. Those things can be like 100 pages plus. But you can certainly skip to the highlights. The valuation section.
But eventually you'll know, and you'll look at a market and say, okay, Simcoe, Ontario, not Simcoe County, but Simcoe, Norfolk County. Right?
Yeah,
and you can be like, okay, $250 a door might be paying a little bit too much.
Yeah, right? I've heard you say that. You're like, this market won't tolerate more than X per door.
And you'll see it on appraisals, and you'll see it as you do your own research, right? You get your on-complete value and you get your as-is value, right? And so, for example, we're doing a deal in Burlington, and then you talk to an appraiser, and he's like, hey, as is, I can get you a value up to $350 a door, right? If the building's clean, if the cap rate works, $350 a door. On complete, he's like, I can get you upwards of $500 a door. Again, if the building's completely turnkey, condo grade, this and that. But you'll learn as you know these different markets. Okay, well, that's my range, right? Burlington's going to be, let's call it 300 and less is like, call your mom, call your clients, call your uncle, we're buying, right? 300 plus to, let's call it 350. Let's explore this further. This might work if we get creative. Anything more than that as a turnkey, not going to work. So it's a quick, again, just go through each market, learn your market, right? Apply all three methods.
Yeah.
And you'll start to get a really good understanding of these buildings. And you'll see, like, ask your realtor to send you some sales comps in the area.
Yeah.
And then spend a half hour, an hour looking through those sale comps. There is a method to it.
You can start finding a commonality.
That's the word I was looking for, commonality.
Yeah, you'll find some patterns. I mean, at the end of the day, the per door thing is useful, but I mean, that doesn't factor in that, some buildings might be all 3-bed, 2-bath units, and some might be all bachelors. It doesn't distinguish between those things. So you do have to take this with a grain of salt, and you have to also realize that if you apply a rule like that, you may miss out on some deals because there's hidden value. Yeah. Oh, it's not actually a unit, so we didn't include it, but it could be converted, or all that, situational adjustment you don't get. So you have to keep that in mind, but that's where if you're constantly looking at an area, and I used to do this a lot, I would see the same listings come up over and over again, and I would start to think, okay, this is sitting, this seller's going to be motivated. Surely I can do something here. Yep. Well, how could I make this into something? And I would work out additions that I could do. I would be measuring the backyard with a ruler, trying to calculate if I could meet setback requirements, reading the bylaw. That's more advanced. But if you're just, turnkey, or you're doing little renos, and you just come up with these shortcuts, you get the juices flowing. You start knowing which deals to look at, and then you might come back and do a second pass and say, hey, I didn't look at that one before, but it was close. Let me take a look now.
And nothing's a substitution for just good old look at the listing and be creative.
Yeah, right? Being creative and making the deal. I mean, we're in a market of making the deal, because the passive investor that could just throw their money down and cash flow, and buy 5 and quit their job. Like, those days in general in Ontario are kind of gone. Like, I'm not saying there's nowhere you could do it, probably is, but it's very uncommon these days. Yeah. So you got to be more creative.
You got anything else, Andrew? Yeah. Any other rules?
There probably are many more. These are just a couple of rules that Jake and I have kind of used. Like the per door rule is one of the ones that I would look at too. I remember I used to argue with Jake. I'm like, oh boy, like paying $150 a door, isn't that a bit much?
Yeah, I guess I can throw one more out there. Yeah. It's not even a rule or a trick or anything like that. It's just cap rates. Right? Yeah. Like, know your cap rates, right?
Cap rates are a big thing. Like, figure out what you can do at any given cap rate.
Yeah. And don't be mystified by the cap rate. You know, some investors come to me and they're like, Jake, like I get it. I get the generality of a cap rate. And they overthink the cap rate.
Yeah, it's
right?
just
And
a
they're
basis
like,
for
oh, like with
comparison.
this market and that market. And guys, like you can literally go Google like CBRE cap rate report, Collier's cap rate report, Altus cap rate report, and like all of these companies will spit out a report being like, hey, over the last year, this is what we've seen, this is what we expected the market to do, and it will literally give you which markets are trading at which cap rates.
So you'll have a good idea of where the appraisers are going to be then,
and that's what the appraisers study, and that's what I was going to say, right? So it's not that you know, just because CBRE says it's a 4 cap doesn't mean you know at a 3.7 downtown Toronto with the right value doesn't mean you can't buy that.
And all of that information doesn't mean that that's a deal that works for you. You have to figure out what cap rate deals need to be at for you to want to do them in the current interest rate climate, based on your maintenance expectations, based on your property tax expectations. Go through all those numbers, figure out the cap rate that works for you, and that might be the cap rate after you're done a renovation and you burr it. Or that might be a cap rate you need to get a property at if you're just doing a turnkey, like buy and hold. But you need to have that thought out. And that might mean expanding your search or getting really creative with the deal and working backwards. Well, cap rate at buying isn't great. But if I renovate this, you know, you start adding to your purchase price with your renovations. And when you come to the final calculation, you compare that to your income, you might be able to turn what was at surface level a 3 cap into like a 9 cap or a 10 cap. And all of a sudden you're laughing because you know that at those numbers, you can make a deal cash flow even at today's interest rates.
That's it.
Big time cash flow, probably at those numbers. And we've done enough of these spreadsheets on this show that you'll have a pretty good idea that when you start hearing those higher numbers, what kind of cash flow is possible.
Well, that's it. And if anybody else has rules or tricks or tips, put them in the comments below. I'd actually love to learn more.
What are your shortcuts? Your quick back of the envelope deal evaluation shortcuts that allow you to spend your time on the deals that actually have a chance of working.
That's it. Right.
Cool. Well, if you've enjoyed this, please share it with somebody you think they would like it. And if you're interested in learning more about specific commercial and multifamily deals in Ontario, Jacob can help you with that. There's actually a link below where you can enter your information, and somebody from Jake's team would be getting in touch.
And then next week we'll be back at it with the deal review. We got a couple good ones lined up for everybody. So I'm excited to get
we talk a lot about creativity on this show because, hey, like at the end of the day, that's what we're seeing. It's a tough market out there, and you have to be creative. So we'll be back with more of that.
Thanks, Andrew.
Thanks.